What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday, everybody. China and the European Union are holding a special virtual summit today, so it may not be a happy Friday for some of Beijing's representatives at the event. Nevertheless, we'll be discussing the important meeting between China and the European Union in tomorrow's China Update. We'll also be doing another deep dive into the ongoing Shanghai lockdown tomorrow. The situation looks increasingly concerning and emotions are running high in some quarters. For example, the Wall Street Journal published a piece claiming that there have been COVID deaths that are not being reported by local authorities, and Chinese domestic outlet Caixin Media is reporting on a public outcry after news emerged that an asthma sufferer and a man with kidney failure died because strict lockdown measures in Shanghai prevented them from receiving urgent medical care. So we'll be discussing the lockdown, the social and the wider political and economic ramifications tomorrow. Now let's move on to today's updates. In a report published this week by domestic firm Huatai Securities Co. Limited, researchers expressed that the impact of China's ongoing waves of COVID outbreaks and lockdowns will take 1 percentage point from its first quarter GDP growth, expressing that supply chains, business expectations, household income, and local government coffers will all be affected. 火信 in Mandarin, or Guosen, Guosen Securities Co. Limited in English, analysts predicted a bigger loss of 1.5 percentage points in their own research work this week. This is what researchers with the Chinese Bank of Communications Co. Limited, a domestic bank, also predicted in a Wednesday report. These three opinions are more optimistic than other forecasts we have seen in recent weeks. Earlier last month, for example, well before the Shanghai lockdowns, JP Morgan Chase told investors that they believed China would see only 0% growth in Q1 this year. Last week, an economist with the Chinese University of Hong Kong wrote that China's COVID lockdowns are likely costing the economy at least $46 billion a month, or 3.1% of GDP in lost economic output. According to estimations from Beijing-based Gevekel Dragonomics, since mid-March, at least 18 cities, accounting for 8.5% of China's gross domestic product, have imposed large-scale lockdowns, with another 20 cities accounting for 13% of GDP implementing less severe ones. Quote, "These cities and their surrounding regions, altogether almost 22% of GDP, are most likely to see broader economic disruption, including supply chain problems. Beijing is, however, stepping up measures to support small businesses so that they are not forced to lay off workers. Most likely, the government will end up accepting that falling short on its 5.5% GDP growth target for 2022 is inevitable, given shocks like these." End quote. Well, I think that may be up for debate, however. Whatever the total economic damage ends up being due to large-scale lockdowns across the country, we do need to keep in mind that Beijing, as has just been mentioned, has set the relatively high 5.5% growth target for the year, and that the incredibly important and sensitive Party Congress is also this year. So local officials will be highly motivated unless they receive different orders from the most senior levels of the central government to both prevent serious COVID outbreaks and meet growth targets. This means that we will likely see local governments respond to growth slowdown with fiscal tools, like more spending on infrastructure, so we should expect accelerations in debt accumulation. Indeed, we are already seeing this week with the State Council yet again announcing the release of special government bonds for local and regional governments to quote-unquote stabilize growth. Now, at the macro level, it only appears like the biggest issue with all of this is the greater debt to GDP ratio, which is an issue. But we also need to remember that while fiscal tools like this can stabilize growth in the aggregate, this economic slowdown from lockdowns will disproportionately hurt households, especially the very low-income migrant worker households, as well as small and medium businesses. SOEs and well-connected established private enterprises will disproportionately benefit from the fiscal response. Next up, while we're talking about the economy, Beijing continues to sound much more optimistic than the US media about the ongoing China-US talks on audit, regulation cooperation between China and the US. We remember that the two sides are seeking to find a solution so that ADRs, American Depository Receipts, a mechanism by which American investors can invest in overseas companies, for Chinese companies can remain on US exchanges. We remember too that investor fear that many may not be able to stay on the US exchange sparked a bloody sell-off in many ADRs in the United States, which spread to capital markets in Hong Kong and Shanghai last month. Indeed, it was one of the steepest sell-offs of US-listed Chinese stocks since the 2008 global financial crisis. Despite a substantial rally too, the Nasdaq Golden Dragon China Index still has not returned to its pre-sell-off price level. Yesterday, the China Securities Regulatory Commission expressed, quote, "The Chinese side and the US Public Company Accounting Oversight Board have had several rounds of candid, professional and efficient talks, and overall progress has been smooth. Both sides are willing to resolve their differences and the issues, and the final result depends on the wisdom and original intentions of both sides." End quote. As we've discussed before, the crux of the issue is that, to quote once again a Beijing-based lawyer specializing in the area, quote, "China is unlikely to consider giving US regulators unrestricted access to work papers, and the US doesn't appear like it is going to tolerate this anymore." End quote. A Washington-based analyst seems to agree. Quote, "I continue to be skeptical that a deal will happen, as it is politically impossible for the PCAOB to give the PRC a special deal, and it appears politically impossible for the PRC policymakers to agree to terms that are not a special deal for the PRC." End quote. These negotiations between the US and China on Chinese ADRs on US exchanges are critical to follow, and we will continue to do just that here on China Update. Guys, if you enjoyed the content, don't forget to hit the like button. It's a huge help for a small channel. It used to be a very small channel, but it's been growing a lot recently. Thank you everyone for your incredible support. If you're watching for the first time and you're getting some value from the analysis and from these types of videos, I release one of these every day. So if you want to be on top of the world's number 2 economy, if you want to be on top of China with up-to-date analysis, maybe consider subscribing. For anyone who wants to go the extra mile, my Buy Me a Coffee and Patreon links are in the description below. A new report discussing China's concerning demographic decline, called Chinese Marriages and Families 2022, was published this week by Beijing-based population think tank Yuhua Population Research. Interestingly, the report, which paints a very pessimistic picture for the country, was covered quite a lot in state media. As we look at the findings of the report, we need to remember that conclusions are based on both official and unofficial data, so we need to take everything with a grain of salt. But the report shows that the number of couples in their first marriages almost halved over the past 7 years in China, which indicates extremely low birth rates ahead. The number of Chinese people in their first marriages, which is closely related to the number of newborns, fell to 12.28 million in 2020 from the peak of 23.85 million in 2013, a 48.5% drop. Marriage registrations fell to 7.63 million in 2021 from 13.7 million in 2013. James Liang, economist and businessman, expressed at a press conference discussing the report that falling marriage rates are seen in both rural areas and big cities because the costs of marriage and child rearing are rising in both underdeveloped and developed areas of the country. The report calls for policies to encourage young couples to have more children. However, most experts agree that this trend of rapid aging, which is only going to get worse, is almost impossible to reverse for at least a generation, if not longer. And last up, just a few quick updates for the housing crisis, the Evergrande Housing Crisis. China Evergrande Group has sold a project from the country's second largest real estate portfolio, a small win for this crisis-hit developer, which has had difficulty selling some assets while also being cut off from credit. The project is an asset in the so-called Crystal City, a mixed residential and commercial development in Hangzhou, the provincial capital of Zhejiang, which hugs Shanghai. According to a company filing to the Hong Kong exchange. The sale was made for 3.66 billion RMB, approximately $575.45 million in cash, and proceeds from the sale will go towards paying outstanding construction costs. We shouldn't be surprised to learn that the buyers were state-owned construction companies and developers, Zhejiang Real Estate Group and Zhejiang Construction Engineering Group. Moving from China's most indebted developer to China's largest developer by sales, this week Shenzhen-based property developer Country Garden Holdings Limited posted another year of profit decline. On Wednesday, we learned that developer saw net profit of 26.93 billion RMB, approximately $4.2 billion in the 12 months ending December 31st of last year. This is down nearly 17% from 2020, which was already a bad year. Since the beginning of the Evergrande crisis, Country Garden was seen by the market as one of the healthier developers in the industry, and as China's largest developer, it's systemically more important than Evergrande. Based on the very poor sales in the sector that we've seen from the first quarter of this year, Country Garden will likely see worse revenue levels for 2022 as well. The developer itself even admits this, with the vice president of the company expressing to investors on Wednesday, quote, "The sector is still at its bottom and we foresee that home sales in 2022 across the country will drop." End quote. Country Garden's total debt at the end of 2021 was 317.92 billion RMB, approximately $50 billion, being labeled yellow under Beijing's 3 red lines leveraging metrics, which we've discussed many times in previous episodes. Not great, but not too bad either. According to company filings, Country Garden's liability to asset ratio, excluding advance receipts, stands at approximately 70%. Despite all this, the general collapse in home sales this year will continue to put pressure on Country Garden and the housing sector generally. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.